Fusion Mobile, quality e-learning experience on the go.
Hello and you're welcome to Fusion Mobile e-learning platform. My name is Jacob Uchenna and I'm to lecture you on economics. So today on economics we'll be looking at the elementary theory of income measurement, that is national income measurements. It is going to be, it is one of the first encounters in macroeconomics. Now, when we are talking about income is the reward for factors of production. That means that you actually have to do something in order to earn income. Although many a time we look at there's income earned and income received. Now, income earned is actually the main income we defined earlier, which is what the income you get after actually producing something or engaging in particular production activity. Whatever reward you get becomes your income earned. But income received is another part. That is a case which may involve a transfer payment such as grants or gifts, aids, and so on and so forth. Now, looking at the whole thing, there was a time we discussed something on the mixed economy, and that is where you have the private sector and the public sector. Now, when we talk about the public sector has to do a whole lot of things. And when they do these things, the activities which they have to perform, they have to actually finance it. And the way they finance the thing, those are the things we studied in public finance. But now, by the time we look at the whole economy as an entity, not just the public sector, we are aggregating whatever the economy generates. That is when we talk about national income. Now, national income actually looks at the total market value or the value of income earned by all factors of production anytime they're over a period of time, usually a year. Now, in a year, everything that is produced is calculated as the income of a particular country or state. Now, before we move further, there are various concepts in national income we'll need to look at. So, concepts of national income. Now, the first one, we have the one we call the gross domestic product. Have the gross national product. We have net national product. Have the per capita income. We have the disposable income. Standard of living. Cost of living. Personal income. Now, these are 8 different components or 8 different concepts when it has to do with national income. The first one, without wasting time, is what we call for short the GDP. The GDP, or gross domestic product, is actually the total market value of outputs or products produced by all factors of production in a year. Now, when these things are produced, what happens is that the economy only recognizes, that is, the GDP only recognizes a closed economy. The question is, what is a closed economy? An economy that does not actually interact with any other outside world, that is the outside world. So in other words, the GDP that considers a closed economy only looks at the output of every factor resident within the economy or within the country at a particular time. And in such case, that means it calculates the income, whether you are a national, that is an indigene, or a foreigner. Now, in such case, that means that provided the factor of production is situated within the country, it is calculated among the country's GDP, or like we say, gross domestic product. Now we move to the next one, the gross national product. The gross national product is the market value, or the value of output of factors of production produced by factors owned by a country, whether they are resident within the country or situated abroad. Now, in such case, that means that gross national product considers an open economy. That means looks at repatriation of funds, then looking at net factor income. Net factor income is just the difference between the income of foreigners within the country and the income of indigenes that are abroad. You add it to the GDP and you adjust it to the GDP and you get the value of GNP. So in other words, GNP, which is gross national product, assumes an open economy and considers only nationals. That means no value of foreigners' income. Then the net national product is the gross national product, the GNP, that is adjusted to reflect the capital consumption allowance. The capital consumption allowance is what we call depreciation. Now, depreciation here, that means that NNP, net national product, equals GNP less depreciation. Okay, depreciation is what we call capital consumption allowance. Now, when we say capital consumption, basically it is what the loss in the value of fixed assets of a country, of a firm, over a period of time. Now, the next one is per capita income. Per capita income is the average income earned per head of the population. In this case, we are looking at the per capita income as just the assumption of per capita income is that everybody earns equal amount of money at a particular time or over a period of time. Now, that means that income they earn within that year defines what they actually use to sustain themselves at that time. Now, that means the per capita income, to calculate per capita income, PCI is equal to GNP, or national income, all over, or GDP over total population. Over total population. That means you get per capita GDP or per capita anything, per capita income. So if you have per capita income, national income over total population, over total population gives us the per capita income. And the next one is disposable income. Disposable income talks about the total amount of a person's income that is left after the deduction of tax allowances. A tax allowance is, of course, the total amount of tax you have to pay as a tax assess measured over a given period of time. Now, the disposable income in that vein now means that we have what? Total income, DI, is equal to total income or personal income, in the case of personal income, minus personal income tax, or generally minus tax. So, at the macro level, you have Y minus T, where Y is the income and T represents tax. Now, this next point of call there is standard of living. Standard of living just talks about the level of the level of things, of amenities that is enjoyed by an individual or by an individual in a particular society. Now, but the cost of living is actually talking about the physical value, what it takes to maintain a particular standard of living. Now, standard of living measured by one of the uses of national income of PCI, that's per capita income, is to determine the standard of living standard, which implies the value of cost of living in a particular country over a period. Then personal income is the actual income received by an individual after a given period, and the personal income PI is actually determined by getting your income by personal income PI is equal to gross earnings or gross income minus income earned, income received not earned plus income earned not received. And this is the gross income is what you have, equal minus income earned not received. Income received not earned means definitely that those kind of things, like I mentioned earlier, transfer payments, subsidies, pension allowances, and so on and so forth, form your income received not earned. But income earned not received, example, is your tax and other necessary or statutory deductions. Now, by the time you add and subtract, then you have what you refer to as your personal income. Now, before we go on, a few questions will be coming on your screen in a moment. You attend to them and we'll be back. Now, you're welcome back. So, on our outline, the next on the list is the uses of national income estimates. Uses of national income estimates. When a country's income is determined, what are the uses of such? What does the government or different firms or different quarters, is there anything they actually use such for? Now, let's have a look. The first one is that it shows the current state or production capacity of a country. Number two, it can be used to measure the growth of the economy, economic growth. Economic growth. 3, is used for policy planning and implementation. 4, it can be used to make comparisons. Can be used to make comparisons among or with other countries. 5, it indicates the contribution of each sector to the economy. To determine the nature and the image of a country, the international community. Now, first, that it shows the current state of the production capacity of a country. Second one is that it can be used to measure the economic growth. That means when you compare figures of national income between one period and another. Then the next one is that it is used for policy planning, policy making, that is policy planning implementation of different programs, of course. Now, the next one, it can be used to make comparisons with other countries. That is for you to know actually the standards or the rate of economic growth between a country and another. Then the next one is that indicates the contribution of each sector to the economy. And last, the national income helps determine the nature and the image of a country in the international community, to know their contributions and so on. Now, the next part we take a look at is the problems we can encounter when we measure national income. Problems encountered when measuring national income. Of estimating or measuring national income. These problems actually make for incorrect or incorrect income values. Now, first among them is what we call double counting. Double counting. Now, double counting. Next one is inadequate. Tools of analysis. And data collection. 3. Inavailability of trained manpower. 4. Unpaid or unrecorded, unrewarded activities. Next one, unrevealed figures. Revealed figures. 5. Revealed figures. Then 5, we talk about what? Hidden or illegal activities. Price instability. And so on, and other kinds of fluctuations. Now within the economy we have what? Double counting. Double counting is actually a practice where you actually, or where you erroneously, in error, count the value of something or an item or value of production more than once. So for instance, by the time you are told to estimate national or the value of the agricultural sector in making gari, okay, yes. Now gari, and you see something for cassava. Cassava happens to be the raw material for gari. So if cassava is 5 million and this is 8 million, you will be wrong to actually say that the national income is 13 million. Definitely, because what? This value of gari contains the cost of cassava within it. So in other words, this will be what we would refer to as double counting, when one value is counted more than once in error. The next, that will definitely give us an inflamed figure of the national income. The next one is inadequate tools of analysis, inadequate tools of data collection, inadequate tools of presentation, and general analysis of such will make the national income estimates. When we now want to make measurements and stuff like that, it will not be possible, or it will be very laborious. The next one is the inavailability of trained manpower. People that actually have the knowledge or skill of actually collecting and analyzing the income figures are in short supply, especially in Nigeria. Then you have unpaid or unrecorded activities, unrewarded activities. Unpaid activities such as activities of relatives, activities of people you call the housemaids or something, just because they live in a person's house. You actually wash the cars and no one, or because they are your kids, they wash the cars, wash clothes, do cooking, and nothing, no reward passes down to them. The next one is talking about the unrevealed figures. That means for individuals or firms who might not want to render accurate accounts, they will present in accurate figures, and the other ones are unrevealed. Then the next one is hidden or illegal activities, which in some quarters are called the activities of the underground economy. Now this, and the last one is price instability. In estimation, when we are trying to make estimations, not actual counting, when price will definitely either lead to an understatement or overstatement of national income by the time you use a single price to set, whereas the current prices are different because of price fluctuations. Now, the last on the outline we have here is methods of estimating national income. Methods of estimating or measuring national income. National income can be measured using 3 methods. The first one is what you call the income approach. Second one, you call it the output approach. Third one, you call it the expenditure approach. The income approach estimates national income as the total of the income earned by factors of production in a year. Now, what that means is that it only recognizes what the reward for inputs to factors of production. Now, when we are calculating national income using income approach, using income method, we add, you have rent is there, wages, interest, dividends, retained profits, distributed profits, retained profits, distributed profits, rent, wages, distributed profits from government investments, surpluses. Now, these make up the figures that will be added when calculating national income using the income approach. Then it will exclude things like transfer payments, like subsidies, transfer payments, then it will add net factor income from abroad, net income from abroad. Now, all these whole things are elements to consider, both the ones you add and the ones you subtract, when we are estimating national income using the income approach. Now, for the second one, which is the output approach. The output approach is a method of estimating national income by estimating the value of final products. Using this method, we don't count or we don't estimate values of intermediate products. Intermediate products are products, of course, that are used to produce other ones. So the value of intermediate products are excluded, but only final products are included in the analysis or in the calculation. Now, if in a case where we are supposed to add this, add value of it, where value of final output is not given, we now use the value added approach to estimate the value of national income using the output approach. Now, the next one, which is expenditure approach. The expenditure approach is estimating national income by calculating the value of the whole expenses of all factors of production in a year on goods and services. Now, such income gives us national income at constant price. That means at market prices. So now, the value which every factor of production actually now spends becomes what? National income. that is their effective demand, becomes national income now for that year. So meaning that with these three alternative methods, it means that we can conclude national income equals national output, which is equal to national expenditure. Now, using the expenditure method, for the expenditure method, expenditure approach, for the expenditure method, we add personal consumption expenditure, investment expenditure, government expenditure, now these three then plus net exports. Net exports is the value on the expenditure on imports less the income on exports. Now the value of exports. Now these make up the what? The total value of the national income using the expenditure approach. Now we've come to the end of this study session. As usual, you have questions on your screen in a moment. You check them, go through them, try to respond to them. Where you have problems, you can go back to the video.